Want to make dinner, drinks, or even a ball game fully deductible? Let's break down how it can be done. I'm Jasmine DiLucci. I'm a tax attorney, CPA, and enrolled agent. I got my first tax license as an enrolled agent in high school. My day-to-day is running my CPA firm and tax law firm. But when I realized that 8 out of 10 people get tax advice from social media and most experienced tax professionals are very camera shy, I decided to put out real information for free. So if there's one thing you can do to help me share real tax law with more people, it's to subscribe so we can replace bad advice with the help people actually need. All right, back in 2017, tax reform eliminated almost all entertainment deductions. If you take your client to a sports game, not deductible. If you take your vendor to a concert, not deductible. If you take your potential clients to a golf outing, not deductible, okay? Only meals that were separately billed from those events remain 50%, not even 100% deductible. But there's one exception that still lets you deduct both meals and entertainment at 100%. And if you use it, you'll want to record those expenses separately in your books so you don't accidentally lose them come tax time. That exception is under IRC 274E4, and it allows 100% deductions for meals and entertainment, primarily for the benefit of employees generally, not just owners. Okay, so to qualify, the event must have a social or recreational purpose. Easy, like a holiday party, summer picnic, or other social event. And 2, the event must be primarily for rank and file employees. Let's go through that requirement. Rank and file employees specifically exclude 10% or greater owners, okay, family members of those owners, even if they're on payroll, and highly compensated employees making more than $155,000 a year in 2025. You might be thinking, wait, Jasmine, my business is just me and my wife. Then the code section is not for you yet until you hire more employees. And if your company has a lot of high earners, there's an election you can make that narrows the highly compensated group to just the top 20%. That way, rank and file employees are still considered the primary beneficiaries. The IRS has tried arguing that that means you can't discriminate at all, like in American Business Corp versus Commissioner, where the taxpayer had around 100 permanent employees at their offices and 13,000 temporary staff placed at client locations. The taxpayer chartered a boat for recreational cruises and let their employees know by posting notices at their office only visible to permanent employees. The IRS came in and denied the deduction, saying it was discrimination. But the taxpayer won because the court found that the statute does not require absolutely all employees to have equal access to recreational facilities, but that it's based on a non-discriminatory, reasonable, and realistic method of selecting the participants. Compare that to Termacalled Corp versus United States, where the court disallowed deductions for a company boat because the business had over 300 employees and they only allowed the 26 executives and managers to use it, so it wasn't primarily for the benefit of rank and file employees. Now, let's talk about what types of activities can count, again with real-life court cases. Okay, in McReevy versus Commissioner, taxpayers tried to deduct not 1, but 2 wedding receptions for their daughters because 82% of the attendees were clientele or referral sources. And I'm sure you can guess that the court was not impressed with that argument and found that the primary personal purpose was clear and that the taxpayer was negligent and intentionally disregarded the law. Now compare that to Cutts v. Commissioner, where the court found that the taxpayer could deduct the cost to repair his pool at his residence, okay, because it was genuinely available for employee recreation and it was also actually used by the employees. Okay, and that is critical here. It is not just stated availability. The court wants actual use, and that use was greater than the owner's use. And that's what tells us if it was primarily for the benefit of employees generally. And that's why things like buying a lake cabin and saying it was available to employees, but then just primarily using it for yourself doesn't work. Like in McReevy versus Commissioner, who also tried to do that in addition to deducting his daughter's wedding and lost that issue as well. So here's the bottom line. If you want 100% business meals and entertainment, focus on events that are primarily for the benefit of your employees generally. Done right, 274E4 lets you fully deduct expenses that strengthen team culture while keeping your deductions IRS proof. And if you want more actual tax strategies, not made up marketing word salad that will get you eaten alive by the IRS, then subscribe so we can keep helping more people with actual tax law from a tax attorney.